Hello everyone, my name is Kautilya Jain and I'm Chief Data Scientist at Signal Capital Partners Limited. Signal Capital is a private asset manager based in London. We invest in opportunities in special situations credit, real estate, and long-term thematic trends. I have around 12 years of experience working mostly on the public side of investing before Signal Capital. I have worked at quant hedge funds and big bracket investment banks and used alternative data and alternative techniques such as machine learning and natural language processing to help make better investment decisions. The title of this talk is Spatial Data Science to Uncover the Where of Investing in Private Markets, which is essentially what I do at Signal Capital. Um, so I'll start this discussion by sharing my thoughts on why spatial data science is important and how it is even more pertinent to investing in private markets compared to publicly listed securities. Then I'll get into giving you a few examples of the long-term themes that guide some of our investments and the corresponding factors that go into the modeling behind those decisions. Next, I will discuss some of the main challenges that a spatial data scientist would face in their day-to-day work. I have broken down the challenges into first data-related challenges and then modeling-related challenges. I hope it helps you plan better about these pain points in your own jobs. In the context of spatial investing, the chasm between correlation and causality becomes even more important. And in the following slide, I'll discuss the dilemma between correlation and causality in the context of making location-based thematic investing. Finally, I'll show you a sample output of the exercise of applying this data-driven spatial modeling before opening it up for any questions that you might have. Um, so why spatial data science? Okay. So let's establish a crucial difference between public and private market investments, which brings in focus the need to explore the spatial component of assets. So investing in public markets is about, roughly speaking, about solving the puzzle of what and when. So you look at securities' fundamental attributes, such as earnings, valuations, macro background, etc., before making an investment decision, right? And alternative data is increasingly becoming more important as well, which promises to give a faster and more accurate handle on the future performance of those securities, right? It's a hot topic these days. Finally, timing is also very important, as in when to buy and when to sell those securities, right? But location is rarely seen as an important factor while investing in publicly traded securities. For example, for these stocks, their corporate headquarters or the that exchanges that they are traded at is not considered a material piece of information while making investment decisions. I mean, sure, exposure to revenues of those companies to certain countries or exposure of operations of those companies to certain countries again could be very important, but the risk is limited to some black swan geopolitical events. And even that too is limited for very big, well diversified companies, right? Now, contrast that with the private investments. There is a much bigger set of opportunities in the private markets with much smaller dollar size actually. So, for example, in the US alone, there are 8,000 private equity backed companies versus 4,300 listed companies, publicly listed companies. Another interesting fact is that globally, since 2002, the net asset value of private equity has grown more than sevenfold, while market cap for publicly listed companies has grown roughly half of that, around 3.2 times actually. So smaller sizes of private businesses and more localized nature, um, they may make them much more sensitive to geographical effects. So consider real estate investments, for example. The most important concern is the location, and then you think about cash flows and other hard financial aspects. Hence, socio-economic, socio-demographic, and even geopolitical factors, which are all spatial in nature, can have a much more impact on the profitability of private businesses or real assets than on publicly listed businesses. So now a question comes, um, is the field of spatial data science using spatial factors spanning, sure, socio-economic or socio-demographic domains descriptive in nature? Are we aiming to simply describe the environment in which those private businesses operate? I would say not really. While the spatial data itself could be descriptive in nature, the model, which is basically, or the modeling exercise, which is basically the importance you ascribe to those spatial factors, or as outputted by your machine learning algorithms in some cases, is the prescriptive part of the equation. So together data and model, they can lead to a location intelligence system which can tell you which locations your business will thrive the most in, or which locations you should acquire real assets in, such as real estate investments, for example. So there's a crucial prescriptive element to spatial data science rather than just describing the locations. So let me give you a few real examples of the kinds of private investments we would make using spatial intelligence, and also the kind of data that helps guide our investment thesis. So let me start with a little background about thematic investing very briefly. So the idea behind thematic investing is that the world is going through constant change, and the pace of these changes accelerates due to certain long-term shifts that are coming to an inflection point. For example, throughout the recorded history, young children have outnumbered the elders. But in 2015, for the first time ever, number of people aged 65 or older surpassed the children under the age of 5. Another example, the sales of adult diapers has surpassed the sales of diapers for babies in Japan for over a decade now, actually. So that's the skewness of the age distribution in Japan right now. And this is not one of example, but this trend only seems to be secular, and it's coming to other developed world or other developed countries as well, as of now. Apart from aging population, youth migration is another big shift that is taking place. So things like cheaper airline tickets or globalization since 90s and access to information made it possible for youth to migrate to places where they can gain better education and jobs, and in turn helping those economies also grow faster. Move to online shopping, another example, especially accelerated due to COVID-19 situation. While it is putting downward pressure on sales in the brick and mortar shopping malls, it actually accelerated the need for industrial logistics and warehouse solutions. Right, the Amazons of the world, they need locations near the big towns where they can actually store the goods and merchandise for speedy delivery. For example, your Amazon Prime solution relies on that. These were some of the examples of how thematic shifts can be harnessed for making investments in these kind of use cases. Um, so use cases such as senior housing solutions or senior care, youth migration, industrial logistics. The kind of factors for a geography that are helpful for analyzing and investing based on these themes can be categorized in broad categories such as demographics, economy or income related factors, quality of life for institutions, and also climate or crime related factors, and so on. There can be tens of such categories, and there are hundreds of factors that capture the essence of people and society in an area under these categories. So, for example, age, gender, education, etc. for demographics, people's net worth, home equity, poverty levels, expenditures, their credit levels, the taxation in that area, etc. for economy related factors. Then things like number of hospitals, number of beds, number of ICU units, the amount of nursing help that is available, the total number of jobs in general, or employment level, or wages, etc. For measuring the quality of life in that particular area. And finally, things like the number of parks, you know, or extreme temperature days experienced by people in that area, or number of storms that come, especially for the US, it's quite relevant, or social inclusion, or income inequality, or even crime rates. They're all they all measure the livability aspects of human lives in that particular area. And and one can dissect these categories and factors, as you see on the slide, as per the investment theme being investigated, as these different factors and categories would have a different relative importance for different themes, right? So different factors will have different kinds of importance for, let's say, senior housing. Something else will become more or less important, senior care. So age, like the age related sort of factors will become more important for this. And youth migration, so there your quality of life, employment, that will become more important. Economy will become more important, things like that. So um, so this exercise of listing down all the pieces of information, and then actually collecting and cleaning data for these factors, takes the biggest effort and amount of time, as you can imagine. And this can be achieved using in-house resources or taking help from third-party data providers. Or mostly it is a combination of, most likely it is a combination of the two things. Now, obviously, this is all good and seems straightforward, but there are many challenges in acquiring and starting to make use of the data. And then there are further challenges while modeling the data to find the best locations for an investment theme. So let me discuss some of the main challenges that hopefully you can also plan about in your own spatial data science projects ahead of the time. So I would categorize the challenges into two main categories. Uh, uh, First is your data sourcing challenges, and then challenges once you have sourced the data. The starkest problem is that there is no one place where you can source all your spatial data. So that is the biggest sort of challenge in my experience. Second, unlike say stock markets where you can aim to model the returns of a security over time as your target variable, and for which you will have a reasonably long history of data available, in the case of spatial data, it's generally very difficult to define which factor would represent most closely the success of your investment thesis. So think, for example, how would you define the success of your senior housing investments, for example, while the phenomena is still picking up? And even for societies which are further up the aging curve, should it be the level of construction activity, or should it be something else that captures the ongoing profitability of investing in senior housing, right? On the explanatory variable side, or what we generally call X variables, that's what I'll call it. What you want is spatial data for as granular as geography as possible, so that you can make targeted investments, right? But for different X variables, you will need to surf through different sources. There might be multiple ways to access that data. Some sources require you to use APIs, and some make data available across thousands of flat files that you then actually need to manually collect. And after all, some of the non-public data might be very expensive to buy. Some of the examples that come to mind uh, for data which is quite expensive but also potentially useful, things like credit and debit card transaction data, or very accurate footfall data for retail investment use cases. Say you have sourced the spatial data that you wanted, but is it readily usable like the typical financial numerical data, say things that you download from Bloomberg and FactSet of the world? Not really. You will have missing values for comparable locations, right? Some of the data coming from surveys might not be very reliable due to the inherent nature of the surveys, right? Some of the spatial data, especially from government sources such as U.S. Census Bureau decennial collection, the data might be outdated. The last decennial data available is from 2010, almost 11 years ago. Some of the data might be non-numeric, which you might need to perform some NLP upon to make it quantifiable and usable in your models. Then the next set of challenges lies with scaling the data and making it uniform across all the factors so that you can model it properly. What do I mean by that? For example, you don't want to interpret the population numbers in a location the same way as income numbers, or the level of education, or which is qualitative, obviously, or the aggregated credit ratings of people in that area. So you need to find a reasonable way to scale this data and make it all uniform across factors for a location. So the data challenges we discussed can generally be applied to many data science scenarios, but some of them are more pronounced for spatial data science exercises. So things like outdated data and non-granular data are the most relevant for spatial data science projects. After you are able to source and clean data to a satisfactory level, how do you model this data to generate an actionable output? So an output that can tell you that location A is better or worse than location B while it comes to making investments based on a given theme. So the first challenge towards modeling spatial data, as I touched upon on previous slide as well, is the problem of defining a target variable. There is generally no one variable that captures what would be an accurate measure of future profitability of the private investments based on a theme. So supervised learning, as we know, is generally not possible in a general sense. So, but however, you can define a subset of important independent variables that can be further modeled as a function of some other independent variables. So that is what that equation here sort of represents. For example, modeling geographically granular and itemized consumer expenditure data as a function of people's demographic markers, such as their age, education, race, gender, etc., etc. So what you can possibly do, since supervised learning is not possible, or generally not possible, what you can possibly do is take all the spatial factor data and combine them in a way that gives an aggregate score of that location based on its reading on those factors. The question is, what should be the relative importance given to these factors? And this is a very difficult question to address, actually. Some of the things that you can do is look at empirical social sciences research and try to extrapolate their learnings for your own scenarios. And that's why you see in the equation that subjective betas are the multipliers for the x variables. But also discussions about these factors with the field experts can help you rank them from most to least important. Another thought that comes to mind is to use the clustering techniques, right? But they are limited in the sense that once you have identified locations which are similar to each other on a particular distance measure, what is next? How do you distinguish between all similarly good or similarly bad locations from a given thematic perspective? For this reason, clustering techniques might be of limited utility, but good, however. Uh, Next, I wanted to briefly touch upon the age-old debate of distinguishing between correlation and causality in the context of spatial data science. So, the block marked as one, where the causality lies in the past, or causality is learned from the past, and the correlation is also in the past, is basically about studying past data to infer relationships in the data. What we generally call the exercise of backtesting. This is the backtesting sort of domain, this block one. Block two talks about the events where past causality results or manifests into present correlation. This is the set of positions people want to hold. This is the most competent area to be in. But the problem is that this might already be priced in, as professionals try their hardest to find these kind of relations using even alternative data or other means, basically. And block three is where the profitable realization of long-term investments takes place. This is where most or all of thematic investments lie, actually. So, in the interest of time, let me move to the final part where I'll show you one example visualization of the outcome of a spatial data science project. So, this slide shows a possible outcome where each location in the UK is marked as per its attractiveness from a retail investment perspective. So retail investment as in investments in brick and mortar kind of shopping malls or even standalone shops. The scores codified by various colors are the results of taking into account hundreds of factors down to the postcode level in the UK. And there are around 1.7 million postcodes in the UK. So it's a very extensive exercise where you essentially create a matrix of 1.7 million rows and let's say 900 columns, where each column represents one factor or one reading for each of those postcodes essentially. Now you can dissect this visualization to further understand how a particular location of interest measures on a particular category of factors. So someone says, okay, you know what, this is a location that I want to study more in detail, but I want to learn more about its demographics or income related sort of forces in that particular location. And then you can compare various locations based on their either final score or their scores on a particular set of or subset of factors. So this is roughly how a final sort of outcome of a spatial data science project looks. But obviously, a lot of work goes into it, starting from sourcing the data to cleaning it, making it usable, and then addressing the modeling related challenges. So this is about it. Thank you very much for your time, and please let me know if you have any questions now.
Well, thank you so much for joining us and sharing some information on your experience with spatial data at Signal Capital. We have a couple of questions in the chat. The first is a comment and a question from James Cutler. He says, many in financial services and insurance recognize the value of brokers to aggregate raw and derived data for risks such as flood, subsidence. Owing to expertise, data access management update, and this is happening in the alt data world too. Do you think this direction of travel is set to continue, or will more institutions want to upgrade their in-house expertise and therefore their overheads?
I read that. Thanks, James. It's a great question, actually, and we also face this challenge almost on a daily basis, actually. I think the trick is that the kind of data which is low in signal value, for example, so things that you can collect from various online sources, those kind of things can be easily sort of outsourced to third-party providers, basically. But the feature engineering part is what we prefer to do in-house, basically. So you have all this raw data, but you want to create very specialized features that are relevant to your specific use cases, relevant to your specific investment use case, and that's the part we tend to do in-house, basically. But to specifically to your question, the direction of travel, I think it will. It's difficult to say. I think people will, like third-party providers, will create their own niche, basically, where their expertise lies in terms of providing the breadth of the data. But when it comes to consolidating all that data for the specific use cases, that's where I think firms like ourselves as well will hire people to do it in-house. Fantastic.
Thank you, KT. And then there's another question here from... Okay.
So, yeah, this is a very this is the most difficult aspect of the exercise we do after having to collect and clean the data. So the loads or the weightings attached to factors in retail rankings, that's there are various ways to do that correctly. So first of all, what we also do is you look at a lot of empirical research. So for example, some university or some students might have analyzed the patterns, how the retail landscapes affected by certain demographic factors in, let's say, in some other location, for example, in US or Germany or France. Then we tend to look at a lot of empirical research and research papers and see whether we can reuse some of those learnings in the locations that we are interested in. So that's one way to go about it. And I'm saying this because it's obviously not possible to run controlled experiments in the location you want to invest in, right? Because the unavailability of the historical data or just the lack of data, for example. So empirical research, looking at empirical research is one way to go about it. but you also speak to the local experts, people who have been actually investing in real estate, for example, in this case, and then understand what is more or less important in terms of driving the valuations of those properties. Then you can also actually conduct very specialized surveys that can help sort of contradict or confirm your own sort of assumptions that you have been making. But at the end of the day, there's a lot of to and fro involved in this exercise of assigning the correct weights to the factors in retail investing landscape.
Fantastic. Okay, well, I think that's all the questions that we've got, Kautilya. If anybody would like to ask you any further questions, they can reach out to you on the Hopin platform.
Yes, please do. Thank you so much.
Brilliant. Thank you for taking the time to prepare your presentation, and we'll be in touch.
Thank you.